Welcome to this edition of India Tonight. We're looking at all the moves in the markets on Wall Street and as they stand right now. Yes, indeed, that pressure has been building up and we've seen this massive slide as far as the markets are concerned in the US. And this kind of slide we haven't seen in the last 2 years. There is a sense of recovery on the Dow Jones, but which are the stocks in focus? Definitely, as far as the markets are concerned, Tesla and Alphabet remain one of the key stocks to watch out for, but the Dow Jones currently is up in the green territory. It's up by about half a percentage point. One stock that we're looking at closely is Viking Therapeutics. Also, the Dow Jones now trading in the green and the S&P 500 and the Nasdaq still struggling to recover from yesterday's losses. There is that better than expected GDP data, which is going to have a bearing on Wall Street, but it's the froth around artificial intelligence and the business that the big tech companies could be doing with artificial intelligence that is creating doubts in investor sentiment, and that's what's affecting Wall Street. At least it looks like that for the most part. Right now, the Nasdaq is down around 0.75 of a percentage point. 17,206 levels is where we're currently at. The S&P 500 is also in red territory by about a fifth of a percentage point. The Nasdaq right now is deepening its losses 0.75 of a percentage. And we're looking at the S&P at 5,418 levels. So the pressure still continues on Wall Street. The immediate question to ask is about the kind of stocks that have slid on Wednesday. That, combined with the disappointing quarterly reports coming in from Alphabet and Tesla, the fears around the froth in artificial intelligence, the overbought conditions and high earnings expectations, also the seasonally weak period for equities. This period generally tends to be a little weaker for the US markets, and perhaps that has a bearing on the kind of slide that we've seen on Wall Street. Also, when you talk about GDP data, it has grown at 2.8% annualized rate in the second quarter, which is much higher than what was expected. The strong growth mainly driven by a rise in consumer spending and contributions from private inventory investment and non-residential fixed investments. Let's discuss what's at play over here. Arnab Das is Global Macro Strategist EMEA for Invesco, and Peter Cardillo is the Chief Market Economist at Spartan Capital Securities. Gentlemen, thank you for joining us this evening on India Tonight. Important discussion about Wall Street, Arnab. To ask you first, why have we seen the kind of cracks on Wall Street as we did on Wednesday, the Nasdaq cracking as much as it did? Is it only about the outlook on AI, or does it cut deeper?
Look, I think it's a bunch of different things coming together. The economy, notwithstanding the 2.8% number for Q2, does appear to be slowing down. On top of that, you've had these, as you've discussed, these earnings misses on from some of the Magnificent Seven. And of course, next week we have a whole series of, further earnings releases from other companies in the Mag 7 and elsewhere. So I think the market is repricing a bit on those expectations. Plus, I think there's a kind of dynamic at work where if we're going to have a more resilient U.S. economy, perhaps depending a little bit on, or maybe even substantially on what happens in the forthcoming presidential election, we might have somewhat more reflationary, inflationary, somewhat lower growth kinds of policies coming through. For example, if President Trump wins, we might have continued loose fiscal policy. We might have restrictions on immigration, even removals from the labor market, which could push up the labor market, the jobs and wages component of inflation, and thereby constrain how much the Fed can ease, right? So in that scenario, you might get less easing, less of a benefit from long duration, whether it's in bonds. We've seen a bit of a steepening trade, partly rolled back, but still there. In the bond market, we might get less lift from monetary policy for long-dated growth and technology stocks, at the same time that many of those stocks may be under some top-line earnings pressure, revenue pressure, right? So I think both things are at work. The Fed, the corporate performance, and the kind of political economy and policy implications of what's going on in the campaign.
Yes, that campaign gets more and more dramatic every passing day. But Peter, what's your sense when you talk about You know, the IT, the tech pack in particular, and you talk about these big tech companies, that global IT outage as well, about a week ago, the one we know as the blue screen of death, it disabled banks, airlines, hospitals, even beyond. Is that also an overhang on investor sentiment right now, besides what we're seeing by way of earnings from Alphabet and Tesla?
Yeah, well, you have to really go back a little bit and look at what really happened in the market. You had the artificial intelligence explode to the upside, and for good reasons, obviously. A new technology that gives us new opens up new paths in terms of technology, and of course you had the big tech groups, the Magnificent Seven, which have been the leaders for many years now, and so the market got a little bit ahead of itself, and what we saw with the earnings from excuse me. What we saw the earnings from Google and Tesla. Google's earnings basically beat expectations, but they're a little bit soft on other components, and so the market needed an excuse.
Correct.
And it found a perfect excuse to basically weigh in on this over speculation. I call it speculation that we saw in the marketplace.
Right. Yes.
But if you look at the fundamentals of the stock market, especially here we are moving into the full season of earnings.
Right.
And if you look at the overall picture, there's been just a handful of stocks which disappointed. Every other companies
in fact, Peter,
have beaten expectations.
Exactly.
And
so when you talk about the larger IT sector, the question also boils down to what's happening in India with some of the earnings from our tech pack, which look very promising. Arnab, I don't know how much you've been following some of the tech results back home in India, which show absolute promise for the future. And US is a big market over there. So when you look at this AI froth business that we're talking about, which has a bearing on how Wall Street has behaved on Wednesday at least, but the outlook, how does that actually play out for the Indian tech sector, in your opinion, Arnab?
Look, I think, India will continue to do very well at a macro level. I think it continue to do well at a market level. I think, the main challenge could be that as, some of the froth that was just discussed in the U.S. tech sector, AI component of the tech sector, and the U.S. economy generally comes off, that won't change the kind of long-term outlook for India, I don't think. But in the short term, it may make people question in the rest of the world, the extremely high valuations. I think nobody doubts that India is going to continue to do well in terms of tech, in terms of contribution to AI, contribution to business process outsourcing, and so on. And that will continue to support the economy generally, continue to support at least an important part of the economy, continue to support the market. But the valuations are extremely rich. So in an environment where valuations and multiples in other markets and in core markets, particularly the US, are being called into question by the economic trajectory, the trajectory of the firms, and whatever's happening in the political side and the political economy and Fed policy, those valuations could become a bit more of a constraint than they have been so far. I don't think it's going to make anyone rush out to get rid of their India exposure or reduce it meaningfully, but it may slow down the inflows, which could have a bit of an effect.
When we talk about the tech stocks back home as well, we have an outlook when we talk about US growth, vis-a-vis inflation, vis-a-vis interest rate cut expectations. So on those counts, how should we be looking at the US markets right now, Peter, when you consider all these factors at play? Because we have the GDP numbers. We are talking about some kind of decline when it comes to consumption patterns. But is that going to be enough to see a rate cut in September, perhaps, Peter?
Yeah, there's no doubt in my mind that we don't see any rate cuts next week. There had been some talk of that in the marketplace, but we did get some a nice GDP numbers today. The economy grew at 2.8%, and it was the consumer that obviously carried the stronger growth. And why did that happen? Well, you had lower inflation. In fact, the PCE in the second quarter averaged around 2.6%. So that indicates that the consumer is continuing to spend if inflation continues to move in the right direction. So I think we're looking at a rate cut in September, one in December, but I also think there's a very good possibility that with the weakness coming out of the Chinese economy, which will eventually have a negative effect on the global economy, that we might get a surprise move by the Fed in September by 0.5%, rather than 0.25%. And I say that because China has been cutting rates almost on a daily basis for the past week, and nothing seems to work.
Indeed, and going ahead now, as far as China is concerned, whether we are going to see more rate cuts and how much of a bearing that's going to have on global markets remains to be seen. For the moment, of course, we are seeing that kind of pressure that was built up on Wall Street. That's coming off, at least if you look at the Dow and looking at the kind of GDP numbers that the US is posting. Perhaps that's the reason why. But yes, there are questions about the future of tech and the froth in AI, and those kind of have a bearing on the way the tech stocks, especially the big tech companies, and how they're performing are indicating. Thanks very much, Arnab Das and Peter Cardillo, for joining us with your perspective on Wall Street and what the future holds.